Monetary policy objectives and central bank tools. Understanding monetary policy and its effective tools. Agenda. Introduction to monetary policy. Primary objectives of monetary policy. Tools used by central banks. Effectiveness and challenges. Future trends in monetary policy. Definition and purpose of monetary policy. Framework for economic stability. Monetary policy serves as a framework for central banks to manage and maintain economic stability by regulating the money supply. Control of money supply. Crucial aspect of monetary policy is controlling the money supply to influence inflation and economic growth effectively. Interest rates influence. Central banks adjust interest rates to encourage or discourage economic activities, affecting borrowing and spending. Sustainable economic growth. The ultimate goal of monetary policy is to achieve sustainable growth by fostering a stable economic environment. Role of central banks in economic stability. Regulating banking systems. Central banks play a vital role in regulating the banking industry, ensuring that it operates safely and efficiently. Managing inflation. By managing inflation, central banks help maintain price stability, which is essential for economic growth and consumer confidence. Lender of last resort. Central banks act as a lender of last resort, providing emergency funds to financial institutions during times of crisis to maintain stability. Brief history of monetary policy. Evolution of monetary policy. Monetary policy has evolved from the gold standard framework to modern practices focusing on inflation targeting and economic stability. Impact of historical events. Key historical events like the Great Depression influenced the development of monetary policies and strategies used today. Current monetary approaches. Today's monetary policy is heavily influenced by past crises, focusing on stability and inflation control to guide economic growth. Inflation control. Primary objectives of monetary policy. Monetary policy goals. Controlling inflation is essential for maintaining economic stability and confidence in the financial system. Central bank tools. Central banks utilize various instruments such as interest rates and reserve requirements to manage inflation effectively. Price stability importance. Maintaining price stability is crucial for preserving purchasing power and fostering economic growth and confidence. Unemployment reduction. Role of monetary policy. Monetary policy plays a crucial role in managing economic activity and influencing unemployment rates through interest rate adjustments. Job creation strategies. By creating favorable economic conditions, central banks aim to stimulate job creation and reduce unemployment levels effectively. Stable labor market. A stable labor market is essential for economic growth. Central banks work to ensure low unemployment and job stability. Economic growth and stability. Monetary policy objectives. Monetary policy aims to create an environment that promotes sustainable economic growth and stability. Encouraging investments. Fostering conditions that encourage investments is crucial for driving economic growth and improving productivity. Boosting consumption. Encouraging consumer spending is essential for stimulating overall economic activity and productivity. Tools used by central banks. Interest rate adjustments. Monetary policy tool. Adjusting interest rates is a critical tool used by central banks to manage economic stability and growth. Influencing borrowing costs. Changes in interest rates directly affect borrowing costs for consumers and businesses, impacting their spending and investment decisions. Consumer spending effects. Adjusting interest rates influences consumer spending habits, as lower rates typically encourage more spending and higher rates may deter it. Open market operations, OMO. Definition of open market operations. Open market operations are the buying and selling of government securities to influence the money supply. Regulating money supply. These operations are crucial for regulating the money supply and ensuring economic stability. Liquidity in banking system. Open market operations help maintain liquidity in the banking system, facilitating smooth financial transactions. Reserve requirements. Definition of reserve requirements. Reserve requirements are regulations set by central banks that dictate the minimum reserves each bank must maintain. Impact on lending. These requirements directly influence the amount of money banks can lend, affecting overall economic activity. Central banks' role. By adjusting reserve requirements, central banks can manage liquidity and influence credit conditions in the economy. Measuring policy impact. Economic indicators. Key economic indicators such as inflation rates, employment levels, and GDP growth are crucial for measuring monetary policy impact. Importance of accurate measurement. Accurate measurement of these indicators is essential for evaluating the effectiveness of monetary policy decisions. Challenges in implementation, delays and policy effects. One of the significant challenges central banks face is the lag time between policy implementation and observable effects on the economy. External economic shocks. Central banks must navigate unpredictable external shocks, such as financial crises or geopolitical events, that can disrupt monetary policy effectiveness. Forecasting difficulties. Accurate forecasting of economic conditions is a challenging task as it relies on many variables that can change rapidly and unexpectedly. Innovations in central banking. Advanced data analytics. Central banks utilize advanced data analytics to improve monetary policy decisions and enhance economic forecasts. Macroprudential policies. Innovative macroprudential policies are being implemented by central banks to monitor and mitigate systemic risks in the economy. Dynamic economic response. Central banks are adapting the strategies to respond effectively to dynamic and often unpredictable economic conditions. Digital currencies and their impact. Challenges for central banks. The emergence of digital currencies presents challenges for central banks in regulating and overseeing new monetary systems. Opportunities in payment systems. Digital currencies offer opportunities to enhance payment system efficiency and security, creating faster transaction methods. Monetary policy transformation. Digital currencies have the potential to transform monetary policy implementation, making it more direct and efficient. Global coordination and policy evolution. Interconnected economies. As economies become more interconnected, understanding global financial systems is essential for effective policy making. Role of central banks. Central banks play a critical role in coordinating monetary policy to address global economic challenges and promote stability. Shared economic challenges. Global coordination is necessary to address shared economic challenges such as inflation, recession, and financial crisis. Conclusion. Role of monetary policy. Monetary policy is essential for maintaining economic stability and addressing fluctuations in the economy. Central bank adaptation. Central banks must adapt to emerging economic trends and challenges to effectively manage monetary policy. Future trends. The future of monetary policy will involve innovative solutions and responsiveness to global economic challenges and changes. Thank you.